Yes, guys, would you please quickly join? Would you please quickly join this? Yes, please confirm I'm audible. Yes, please confirm I'm audible. Yes, Abdullah confirmed. So I verified from here also. So let's continue. And meanwhile, still we are on there on Zoom. So there you can unmute yourself. Thank you, Abdullah. Thank you, Adnan. I believe you can speak from the YouTube as well if you unmute yourself, and anybody can test over there, because from there also you can unmute yourself and raise the question. Would you please just help me out in this for testing? Because once we start, then we will not able to stop. Okay, let's dive into the our topic. Join. I'm not sure the participants are there, but the response are not so quick. Good morning. Today is our session number 10, day number 10, dated May 24. The part is 24. So now we're gonna start with the our today topic. And today topic is the same continuity of the previous topic. From the previous topic also, if we are looking for the computation, our focus is on the computation, the calculation of the corporate tax, where we learned that we will start our calculation profit before tax, and the same activity we are continuing. But now we covered almost 12 adjustment as per article 33. Article 33 in the previous session, we covered the 12 items that we will adjust. And under that, for each topic, each item, there is a further sub item that we covered. So that is our base. We covered the framework of the overall text. So now we are diving into each section and where we're gonna learn. So if, what are the further detailed implication are the technical aspect of the each topic and how that will be addressed in the Carbotax return filing. So we will show you the practically the section of the Carbotax return belongs to each topic. So now we are on the our previous topic is the unrealized gain. Unrealized gain that we are choose for the if we say, choose the option for the election, and this is the one of the election that is the mandatory and that is the irrevocable, that is the lifetime. Even we choose or by default we move on, it will be elected. So we are this understand in the part number 23 unrealized election. We did one practical example with scenario how the unrealized gain gonna affect. So now under the unrealized gain, there is another implication of the UE corporates. They given the option for the transitional relief. The transitional relief means the first tax periods, mostly during VAT was there, that also time the transitional rules were there. So now the carbo tax again for that the transitional rules are there. So if we just understand what is the transitional rules, I believe most of you are familiar, but still I'm gonna add over here the transitional relief. Whenever the new taxation or new activity are there, are mostly, let's say, they cut financial year. So we are familiar in routine activity, year end. Year end, we say the cutoff. This is one of the common activity. Every year end for audit, we are closing books at each year end. And at each year end, if let's say our financial year is the December ended, so December ended 31st December, let's say the 2025, this is the last financial year end, financial year end. So this is we are familiar with the word of closing. We are familiar with the word of the cutoff. Okay, and commonly closing is the another one of the topic. Mostly the big corporate they're doing the monthly closing. Okay, so mostly they will say, okay, by end of month our books are closed. Okay, and into head office afterward we cannot do any transaction or the recording in our accounting system. Okay, so this is the same way the text also saying the transitional rules means before tax, before city, and after city. So this is the cutoff. Okay, before whatever you have that was not subject to tax. But from the if your first year is the 1st January 2024, if your financial year is Jan to December, so this is your first tax period. If your first tax period start, so then you have to make the cutoff. Then we have to make the cutoff. What is our cutoff? 31st December 2023. So tax law is giving us the option. You make the cutoff under certain guidelines that help you if you are meeting that conditions. So why that condition? The thing before tax, here the before tax, whatever the property that you have may not pay tax, may not subject to tax. if the conditions are met. So whatever the amount that you have before tax is not subject to tax if you met the condition, and afterwards from first tax period is subject to tax. Only the value or the portion after the first tax period onward, it will fall under the compliance or under the taxation. But this is not the automatic. This is we have to opt this election, then we have to uh, meet the applicable conditions. So the word transition, I think we familiar now. What is the transition? So if we are familiar with the transition, so which means there will be some income belongs to before tax. So we have to make the cutoff, and whatever the income after the cutoff, after the first tax period, start from the first tax period. Here we discuss the first cutoff date is this. So whatever the income coming afterward is subject to tax. So now the big corporates world, they started such activity when they come to know the UE law working on the taxation. Maybe early 2022, because the law is came in June 2022, but the news was there before the. So they knows in other part of world how the taxation and how the impact gonna come to our organization. So the most of the consulting firm, they were engaged with such giants from beginning of 2022, and some of them, we can say the mid of 2022, because this is not the easy task, because the big giants, the big corporates, they have very complex structure. So to understand that is need the time, skills, and resources. Now the question is coming: is the tax law is not there? The tax law came in June 2022, and the first date of effective of corporate tax law is the 1st June 2023. So they will say, okay, if the law is not there, how they are working? See, the mostly the law coming by considering the existing tax regulation in other part of world. So now the UE tax law is they have certain are the primary theme from the Netherlands. Okay, so if they have primary theme from Netherlands, so people are familiar how the in Netherlands taxation is there. Of course, they have their own facts and the figures are the tax rates, but the base or the framework, we mostly the people are the professional working in the taxation, they are familiar how it's going to impact and which area going to impact. It may differ 20%, 30%, but ultimate that area is subject to tax. So that's why they start scrutinize their accounting and their transaction, their asset, the mechanism of the, in order to meet the compliance of the taxation and see what are the possibility or the within the compliance what we can do in order to remain compliant and remain optimized in terms of the taxation. So far any question? So far any question, please? Any question, please? I appreciate topic by topic if you are saying, because now I'm gonna start this. Okay, this is one of slide I shared. So the different assets have the different application of the IFRS. Why? Because it's important while applying that. What I mentioned, different assets and the applicable IFRS. The treatment on each asset may be different IFRS. So then accordingly the implication also there. So this is the just the overview. If you see the IAS 16 dealing the property plant equipment, if you see the intangible asset IS 38, if we are seeing here the inventories, IS2 is dealing, and the construction contract IFRS 15. Okay, so maybe IS 16, IS 40, and financial instrument we can say the IFRS 9. So first law is saying, okay, whatever the accounting treatment you are doing as per applicable IFRS, you take that treatment and then come to the city law, and we will tell you what are the implication. Okay. So if we know the law and the we understand, okay, it may applicable on inventory, it may applicable, it may not applicable over here, it may not applicable over here, it may not applicable over here, or it might be versa, it's not applicable over here, is applied. But how it will be? Based on this IFRS policy that organization or a lead taxable person is following. I'm not saying that if you follow the IS2, it will be falling under the transitional rule or not. I'm saying the implication of that matters while looking into that the transitional rule will be applicable or not applicable. So here the IFRS knowledge are mostly getting the comments. Okay, then we must learn the IFRS. See the IFRS. Most of the professional maybe they are not familiar with the IFRS. Earlier, we also learned so in each organization the IFRS team may be a separate team. This is the reporting team. At entity level, they already discussed and applied the IFRS, right? Accounting team is a different. Accounting team is a different. Then the next tax team is a different. Our team or any term we can use. So primarily we are looking in each organization. There will be a three primarily the department. So they are doing their own activity, our own compliance, our own work, our own scope. So at a time we are focusing on the tax. Okay, even you are not part of the account IFRS, you still good to go with the tax internal team. Why? Because you primarily looking for the tax compliances, and the tax compliances they have the certain guideline. They have certain guideline. So you are saying, okay, this law will be applicable under this scenario and this scenario. If the while reading the financial statement, we will understand, okay, because tax law is saying look for the let's say the cost. Okay. So while reading in the financial statement, we are looking the cost if is applied or not applied. Okay. You might you don't need to apply the IFRS. You can highlight to the relevant reporting team, highlight, a trigger, a refer, look into that as per IFRS. So that's why we are focusing if the audited financial statement, the proper disclosure are there, if done by appropriately, so of course they will mention the disclosure. Then the tax consultant or the tax accountant, he may able to understand which tax law I have to apply, in which direction I have to go. But if this reporting or this IFRS disclosure in the financial statement is not mentioned, not even mentioned, not clear, okay, is not properly addressed, okay, the notes to accounts and policy of the financial statement, if not addressed in the audited financial statement, okay, so even whatever they are doing is correct at this stage, but it may not be correct at this stage. It may get trouble. Why? Because while following the disclosure and the financial statement, limited or inappropriate information, okay, is give us the raise the risk of non-compliance. This is not the mistake of the tax accountant or tax consultant. Why? Because he did not get the proper information. So this is the one of the factors that why we are focusing the let the auditor do his job properly, let the accounting team do his job properly, then consultant or accountant he able to apply the correct regulation. Okay, but practically we seen they are expecting from the auditor to do everything. So auditor he's not familiar 100% of the taxation. There is certain scenario because if he's a familiar, so then he is 100% occupied in this taxation. If he's 100% occupied in tax, why? Because he's continuously learning, focusing new regulation and understanding. He maybe he passed work in the audit, but currently he's primarily on the tax because the new regulation is frequently changing, updating, so he will be occupied. But if they imagine, okay, he can continue with the audit and in addition he's trying to add the tax also, he may suffer on that. Okay, I'm not saying it cannot be, but it will be challenging. He have to make the more time and more activity. Anyhow, so this is the again we understand the different asset. This we will understand in today exercise how this implication may impact. This is why that we add this slide. So let's take the quick overview of this slide. Before that, if you quickly please confirm I'm audible, every slide is visible, although I'm seeing on that other screen everything's going well. Any questions so far, please? Any question before starting this? Any question so far? We understand what is the our topics, and we understand what are the different accounting standards, and as the application of the each standard, the result will be differ. I appreciate your question. Your uh, would like to learn anything specifically. Okay, so let me go back. Okay. So first we are saying the asset. Now the asset definition controlled by the business or probable economic future benefit. See, I just highlighting is word is not owned. The word is mentioned control because IFRS is on the economic reality. IFRS is on economic reality, economic facts. Why? Because IFRS is saying substance over form. Substance over form. What that mean? Who's the economic beneficiary? Who's economic beneficiary of that asset? He is not mentioning anywhere the ownership. Okay, so keep in mind the IFRS given us the guideline to the economic beneficiary. That's why the controlled by the business are probable economic benefits toward the asset, toward the I'm gonna see the LLC company. Okay, just for taxable person, the definition is a taxable person. Okay, the purpose or objective of holding asset by the business. Now, the purpose or the objective of holding a asset by the business, because each asset category is a different. Maybe the same asset for one business is the inventory and for other business is the PP. If a distribution company is doing the particular Plant distribution, so maybe plant, and here is the manufacturer. For here is the asset, and distributor for him is the inventory. Why? Because he the manufacturer who manufacture the goods by use of that asset, by use of this asset. So that's why they call the plant, right? Manufacturer, asset, plant categorized under asset. For the distributor, the plant categorized as a inventory because he's buying and selling that plant, so that's his inventory. So now here IS2 and here IAS 16. So here we are understand the same item for one business is the inventory we will record as per IS2. For other business is as a plant as a fixed asset. So we have to see what are the each asset, what are the economic reality of that asset toward the business. We are diving into each area. Why? Because this is important. Even we know the law, we cannot apply because if we didn't understand these fundamentals. So I try to add in the each section the some applicable fundamental. You don't have to know all the IFRS, but if you are familiar with that, you go and check the certain point. Okay. Now let's see the asset held for sale. Ordinary activity. First, we have to see. Okay, held for sale. We have to say this is his ordinary business, like he's buying and selling. This is the ordinary activity. Primary activity, SIGA activity. We are buying and selling. So we have to look into that. Yes, if we're saying yes, then it will be the inventory. IS2 will be applicable. But the second scenario where we are saying it's no, but the second scenario where if we say no, so then it will be non-current asset, held for sale and discontinued operation, right? So here we can say the IFRS 5, held for sale, discontinued operation. The first point we understand. Now let's say held for use in business, tangible asset. This is also because business software we are using, these are the intangible asset, right? The plant and machinery, land and building, these are the tangible asset. So if these are tangible assets, so we will see, okay, PPE is, if we going here, the PPE will be IS 16. This is the important factor belongs to the today topic. Then the second category is the intangible asset. Intangible asset, brand names, goodwill, trademark, okay, landing rights, whatever the rights that we have. So it will be dealt as per IS 38. I'm just giving you this overview. We are not diving into the each standard. If we know all these factors, so it's good to go for the tax accountant. Okay, the land and building held for rental to others for our capital appreciation. Now, the land and building, if we buy the land and building and we given on the rental and we are looking for the capital appreciation, if after 2 year, 3 year will be increased. Let's say I'm giving, if today we buy the property from the Imar property, we believe the market value is lower. So let's say the earlier market value was 1.5 million, old price, and now is 1 million current price. Okay, so if we buy now the okay 1 BHK in the Marina area, if we buy 1 BHK and we say okay, put on the rent, and once the market conditions are better, okay, market conditions are better, let's say after 6 months, let's say I'm taking the example December 2026, market condition is better and the same asset Market price reached to back to the normal 1.5 million, and we sold. If we sold, so we have the gain of 500,000, plus during that period we have the rental income also, right? So now this is the called the where we was the investment property. I just given you the basic. So investment property dealt as per IFS 40, right? If we're saying this building is not for the investment property, okay, then what is the other option? It will be if we're using the same property for our own factory premises or office premises, this is the PPE, then we are dealing in the IS 16, right? If we are setting up our own office, our own factory, our own distribution, our own warehouse, then it will be part of PPE. But if we put on the rental purpose and earning the income, and we are waiting for the under this scenario capital appreciation, then it will be go as per IF 14. Now the another held under construction contract, some contract construction for someone else business. Okay. Yes. Again, we are saying if we have the held under construction contract, construction for someone else business. Yes, IFRS 15 construction contract. If no own use or rental, if we're saying we are building that property but for our own use or rental, so again earlier we understand if our own use will be 16, if for rental IS 40, right? So here the financial asset, monetary asset. So again, investment in shares of the company. Same like in earlier, we also took the example. If we buy the Imar shares, Imar property shares, the current market value is 11.48. Okay, so maybe on Monday this price will be 12.80, based on many economic factors are the regional the factors. So it may come on the 10.80. Again, depends on facts and economic situation or the other political factors. So now here we're saying this shares that we buy from the IMAR, this is the monetary asset. One of the example, investment in shares. So if you buy the IMAR shares and you kept for what reason? Investment in share of other companies or loan given instrument in sukuk and bonds. Yes, if we have under these categories, financial asset, IFRS 9 is dealing, right? Here is the biological assets like animals, agricultural. So this will be rare case if we come on that, like the Al Rawabi farm, like the Alan farm. There's another, dairy products coming from the Al Rawabi, Alan. There is, I think, a couple of other dairy product manufacturers are the milk providers. Okay, so that fall under that. So now we understand these standards. So now we gonna come to the our topic and we'll see how it gonna impact us. Transitional rules. This is the our topic. So here we are learning the transitional rules. What the outcome will be, the transitional gain. It may come gain, it may come loss, will not be taxable on certain assets and liabilities. Okay. So now this is the possibility under this specific scenario. So now we are saying the excluded gain. What we have to do, we have to calculate the excluded gain on sale of the asset in the first tax period. What is the important? First tax period. Second is the gain. A later on at the gain, or later on at gain, then minus some of the gain which started. So the point is that in the first tax period, we have to see the gain, what is the gain at that time. But one factors are one important part that we have to be focus. What is the our objective? Excluded gain. Why? Because we are continuing the competition of corporates. Computation of taxable income, right? From where? Profit before tax. The profit before tax, this is the our starting point, and in which we what we're gonna do that adjustment add or less as per article 33, right? And the 12th item. So this is the one of that we are realized or unrealized gain, that adjustment we are continuing. So which means we have to see what will be the income may already added over here. If the gain is already over here, we have to minus. But now here we are saying we have the asset, but as a excluded gain. Why we are doing the excluded gain? That is already added over here. Let's say that taxable income is a 100 plus at the year end of 31st December 23, this gain is added. Okay, so now this is the 110. So we have to calculate this 10, recalculate this 10, and whether this 10 is meeting the condition of transitional gain or no. From which balance sheet? This is the balance sheet of 31st December. So how much the gain, it may add it or it may not add it, we will understand. But here we are, any class of asset we have to calculate. Why I'm giving you this example? Just to refresh the our concept where we are. Okay, so we are what we have to count, what we have to calculate: excluded gain, first tax period. And this is what we are doing on deemed sale basis concept, on assumption asset is sold. Asset is sold. How it will happen? Let's. So we understand we have to calculate compute excluded gain at the first start of the first tax period. So which area will come over there? Which area will come over there? Qualifying asset. What is the qualifying asset and liabilities? Because all asset may not meet the condition of such gains exclusion. So that's why they use the word of qualifying. So now we will understand what are the qualifying asset and liabilities. So one of the qualifying asset, they given the name, but subject to further condition is met. Immovable properties, intangible asset, financial assets. So we'll dive into that one by one and we'll learn immovable property. What is the that? The second is the important prerequisite conditions, terms and condition. Of course, whenever that law is coming, he is specifying the some terms and condition. So which are the terms and condition? They are saying yes, if they follow the cost model. This is the important factor. Why we understand the previous slide where we different standards, because in this standard we have to see asset is recorded at cost model, because each standard give us option for the revaluation or market value. So now if we treated that particular asset on the revalued amount or the market value, we cannot apply this transitional rules, right? So one of the prerequisite are conditions T and C cost model. The second must be purchased before first tax period. Like our first tax period start from 1st Jan 2024. So then asset must be purchased before this date, like 2022, like 2023. Why? They're saying before first tax period. If asset is purchased on, let's say, the Feb 24, so it's not subject to transitional rule, but it will not applicable. So if we purchase before that, that condition will be there. The first we said the cost model as per, because standard may give you the option for the value revaluation, fair value, or cost model. But all these transitional rules will applicable where the asset is purchased before first tax period, and is in accounting we are using the cost model, right? We have the recently one client where they have the properties, the warehouses, sorry, the labor accommodation. They have, I think, the 25 or 27, something like that. Because the labor accommodation standalone is a business, they might register with the Mori, and they give the beds. If they approve the labor accommodation for the 500 beds with the Mori, so each company, because they have to provide the accommodation to their labor, so they might take the 20 beds and they will register with the Mori. This is the accommodation they taken, and they depends upon the companies what are the labors, maybe 100 to another company, 50 to another company, 250 to another company. So this labor accommodation itself is a business. And of course, if you apply with Maori for the visa quota, the company, so then they will ask these details. Okay, what is the accommodation uh, facility you have? Because if you have only the labor accommodation with 10, you might have your own labor accommodation, and might you take from these providers, so they will give you only 10 visa quota. Okay, so if you want to have the another 10 quota, so then you have to go and ask them, give us the another 10 beds. So they will approve on the Mori, upload on the Mori, and link with your company. So you will get another quota. So this is the visa quota. How the the ministries monitors ensure that the labor is here. They must have the necessity or the uh, basic rights to survive in the country. Apart from that, we also familiar with the WPS, that is the additional. Anyhow, so this is the another. I give you the concept. Anyhow, come back to the our original agenda. Okay, the first the cost model, second before first year, third is expecting, is not actually saying you are expecting. How the expecting? We know the market of the particular asset. We know the market of particular asset, at what price we buy and what is the current, because due to inflation, due to other factors, prices may go up. Even we buy, let's say, any car, even we buy any car, not only in India, Pakistan, maybe we see that if we buy any brand car, let's say the Toyota, or I don't know, and we can say the Hyundai. We are just taking the example for understanding. So if we buy the car in 2020, in India also, the Tata is another. If we take the example Tata, so if we buy the car from the Toyota, the custom duty is, let's say, the 50%. Okay, in 2024, the custom duty is 100%. Now the same car value is increased. We buy in 2020, and then now the price is changed by another 50%, because if the person buy the car inside the country, so this price is different. If he import, again the price is different. So here the concept is the local manufacturer manufacture versus import. Same concept in UE, ICV. They are promoting in that. Okay. So this is the many factors. I just given you the car example because we this is correlate with our routine practical life we seen in the market. We are familiar with that. So that's why I given you the example. Okay, now we first tax period. Then the next is at ALP, arm length price. Why? Because maybe we are buying the car. Let's say take the example, we are buying the car or the property from our family member. So to avoid the taxation, they might say, okay, the market value is 100. Okay, you can give me the 70, and 30 you can give me the cash. By paper is this, but market is 100. Market value is this, right? So the law is saying even whatever you did, okay, to save the stamp duty. This is one of the local taxes on the properties. To save the stamp duty, maybe you have done X, Y, Z. That's why they call the DC value. Anyhow, so the 100 we have to record at the arm length 100 only. Even we did this exercise. So that's why they added this concept. Okay, so far we already, I think, 30-40 minutes today topic. So just imagine we are gonna preparing our base before come to the topic. Let's start the topic. This is the return. So where the return it is shown these elections. So before coming in that, so I appreciate if you let me know if any question, please. Yes, we have with us Abdullah, we have the Adnan Naseem, and anybody else, please share your comment. Uh, I'm audible, slide is clear. Any question? Any question there? I appreciate your if you have any question, anything that you'd like to mention over here. I'm taking the such breaks to understand if anything from your side. Anyhow, so now this is the practical scenario why we are doing all this activity because we previously faced such questions first. Because if we start the topic directly, the people not understand why we are doing. What is the reason? What is the rationale? Of course, this is a basic question must come from the all the the professional who are learning some specific topic. Alhamdulillah, we covered the basic understanding. So now, okay, if we have the understanding, then again, why we need to learn that? Because this is come in the corporatex return under the election. Under election, we have transitional rules. Because if we are not familiar under return, this is the corporatex return. I believe we already knows, but again, I'm writing UAE corporate tax return filing of the relevant area that the topic that agenda we are discussing. See here, the first question is coming under transitional rule. If we are opting, see how the return are filing in the market. Okay, this is the box. This is the box. If they go for this box, this is the box. This is the box. This is the box. Literally, I'm sharing. If we tick this box, so there is another box. This is next step. If we know the hit and trial method, okay. If we tick this, so there is a no box. No further box means no further application. Okay, by mistake, if because this is hit and trial, people are just testing, is not familiar. People are all people are familiar. I'm not saying nobody knows in the market, but I'm saying uh, everybody is not familiar. And if they tick over here, so they see, okay, what is this? This field, this field, this field. And if they are not familiar from where these figures are coming, because they are not familiar with the transitional rule, how come they will fill these fields? So they say, okay, let's go back here. They go back here, they move to the next step. So now all these fields are blocked. So this is the how the return filing, and the people saying, okay, we are doing well. And the client who's also not familiar, he said, I filed the return within 2 days. Good to go. This is the reality. Anyhow, come back. Okay. Has the taxable person held any qualifying? Okay. We have the asset, but whatever the asset is meeting the condition, immovable property, intangible asset, qualifying financial asset, or qualifying financial liabilities. Immovable, the first part is the first is this immovable property. Second is intangible, right? And third is financial asset and liabilities. You understand? They are covering the three area, and today go back and see the our agenda for the day. Is the same? Is the same or no? Immovable property. Then the second is intangible assets. The next is the financial asset or liabilities. These three assets we are focusing today in this topic. One, two, three. And the return is saying the same thing. Now, just imagine if we are not familiar with this, if we are not familiar with this, how you will say yes or no? Because if you are saying yes, so further field is going to open, and we don't know what are this. So what is good if the person is not familiar, he's just doing the return, and because the issue is that the I'm going to use a business owner is not familiar with city law. Try to understand this part is, and anyone who's filing the return, he he also not familiar 100% with the city law. He knows randomly how the randomly, yes, if we go take, it will be moving forward and somewhere khalas. And somewhere if we stuck, so we have to just instead of this take this. If it's stuck, then go back this, hit and try. Because the objective is to submit the return. Their objective is not to submit the compliant return. Okay, and this person also knows the business owner is not familiar with the regulation. He knows, I don't know. How come the business owner will be know? They start bargaining. He will say, okay, I will take the 10,000, and business owner will say, okay, take 5,000. Let's do it, because he don't know the required skill, and he knows it will take hardly 1 or 2 days. What I have to do, plus minus, and submit the return. So this is the advantage that they are taking, and this is the worst scenario the business owner will suffer, because tax he is liable for each year up to 7 years, and it may extend may extend if he receive the notice from FTA before end of 7 years. Let's assume 6.9 years is completed, FTA send the audit notification. It's about to complete for the first tax period, 6.9 year is completed. He received the FTA notification. Now that year subject to another 5 years. He should keep, because even this happened practically and they when they return new regulation in June 2022, some changes are happening in the VAT. So we've seen in the market many people receiving the FTA notification for audit. Okay, but only 20% of them actually, I'm just taking the assumption 20% or 10% may be actually audit, but now the balanced 80%, their compliance will be extended till another 5 years. Why? Because FTA have the the uh, just imagine a whole at the country level how many audit queries there is. So they step by step coming to that. So I'm not saying they will not come to balance 20%. They come step by step on that. So if come after so the first tax year will be out of that. Now it's remain in the subject to. So total 12 years. Just imagine 12 years. So this is why the corporate world, they are focusing and they're giving the importance to the local regulation and the taxation. They know we will remain in the business, and in future such queries will make trouble for us. Okay. So now here we understand why transitional relief rules are important, and we understand there are the three assets or three category of asset we have to. So if we are saying the no, so no further implication. In case of no, no further implication. This is the you go and check in your return under that it will be same scenario. We prepared from the same. Okay, and the next is the as the taxable person. First we said no. Let's take the and this is good to go because no further calculation. And second case, if we saying yes, we have the financial asset. If we have the financial asset, this I given the earlier example because the people are not familiar. They file with the no, and now they come to know how much the advantage we may take if we opted for this. We may take more than 100 million taxes, depends upon the corporate, 100,000 taxes by correct application or the by beneficiary application within the regulation. In case of yes, three fields added are open in the return. Why? They will say, okay, if you have this, share with us the detail and numbers, facts, and figures. Right? Now this is the next. After that, the field is coming. Transitional rule, qualifying. Now we are focusing on one of that. Earlier we seen that three. Now they are going one by one. This is the one of three. So the three category, now they're saying, how about is the taxable person making an election to adjust taxable income for gain recognized in any qualifying immovable property? The word any. The word any. This is another important learning, another important fact that we will dive into that, but I may add over here another. We might go into the ministerial decision and see over there also. But I would like to share here along with the return. And maybe the this is the new change, a new regulation. Maybe people are not familiar in the market also. The word any is important. Word any is important. Let's say we have the 20 properties. So we might choose for only 8 properties this election. And 12 properties we might not elect. So this is again the choice that we have as per the tax authorities. Again, this 8 we chosen based on the available, the facts and figures. What are the beneficial for this? So now we have to look into that, and we have the immovable property or no. Second is the first tax period. How we add yes or no if we are not familiar. We do understand some of the today understanding, but let's dive after this corporate tax return filing the that relevant application. Taxable person can make election to exclude an element of the gain and disposal. What is saying the exclude? If we choose this election, then this is the another irrevocable election. If we say yes, then exclude an element of gain on disposal of immovable property held prior to first tax period. This election gives us the opportunity to calculate the taxable gain that is subject to before first tax period. We can exclude from our tax computation when the actually asset is sold. So I try to give you one by one, but here I'm going to say, okay, the asset value, qualifying asset value, let's say is 250, the original purchase, and let's say original purchase happened in 2020, and in December 23, I'm writing December 23, the asset value was the net book value is the 150 millions. Okay, these are millions versus the market value. As earlier we discussed these two different factors, the market value is 400 million, right? At this, at December 23, market value is this, net book value is this, right? I'm just make the clarify here. Net book value is 150 million. So if we just take over here market value 400, what is the gain? Market value 400 million. So what is the gain? 250 million is gain. I'm correct or no? 250 million gain at that time. So we are saying if we opt this election, so this is the our excluded gain. But this is the on assumption on deemed sale concept. We are saying this is the market value and this is the deemed sale. The deemed sale are assuming that we are assuming that we sold that asset, right? So this is the concept of the gain. So what we are trying to do, how much the excluded gain. So this gain is subject to before city. So you this let me know. You guys would like to pay the tax if you are as a business owner. So you want to pay tax on 250 million, 9%. You want to pay the 9% tax. Are you, if you have tax, give you option, choose not to to pay tax on 250 million. Which one you would like to take? I appreciate. Please let me know what is your understanding as a business owner. As a business owner, would you like to pay tax 9%? I appreciate your participation. I appreciate your participation and your response. Amir, we are already sharing the screen on the YouTube and people are already joined over there. Maybe you're not joined from the YouTube, that's why you are mentioning in the Zoom. Anyhow, we just added over here also. So let's see. That's why I'm avoiding to continue on one screen. Okay, so now we will back with the same. So our question was, can we pay or would like to pay the 9% city? Mr. Prabhu mentioned is no. Okay, so here the idea is that so we have to be rational, and the rational, once we know what are the possibility, what are the the understanding is there, right? So now, as we understand, we don't want to pay. Yes, gain is excluded if asset is disposed, assumed sold. Yes, dear Mohammed. Yeah, here, see, because of course at the first year we might sold, we might not sold. We are not saying is sold, but at the first tax period, we are doing the cutoff. In the financial accounting at the end, we're doing the cutoff. So why we are doing the cutoff? Because we have to calculate this. And if we are doing this, what are the prerequisite is there? How we gonna do that? We'll opt for that, and then we will add the figures. Because if you sold asset in 2030, so at that time, how FT, you know the what is the market value of that? This market value from where is coming? Because today we submit to FTA the valuation of particular asset in first tax period, we have to submit the valuation if the asset value is 400. So then in future we are eligible to say we have to we have to take the excluded gain based on this valuation at this calculation. So that's why this is the important in the first tax period. Okay, so now let's see. In case of yes, accounting adjustment transitional, below box will be open. Has the taxable person disposed of any qualifying immovable property during the tax period? See, if we already opted that, now this is saying, okay, maybe in 24, we opted that. Okay. Now in 25, let's assume here, in 25, the question is coming, did you sold anything? We will say yes. Then this trigger, the excluded gain option will be trigger. If we say no, it will be carry forward. Maybe in 2030, we will say yes. Then this option will trigger and we will do this calculation because we already given the valuation of particular assets. So now we'll see how to calculate on that. I believe the concept in the return, you understand that. So if we didn't sold, we opt for no further calculation. So if we opt for yes, then he will come back on this adjustment in respect of the gain. So he's saying how much the adjustment that you made on prior to first year. So this adjustment, that 250, we will write over here. So this, we added the full profit into the our tax computation, then we did the adjustment over here. This will reduce our taxable income. So it will reduce our taxable income. What is the owned prior to this? Is we understand first tax period. And this is the, we are looking into the immovable property, particularly one of that. So now how this adjustment is coming and what are the option, what are the methods? So we're going to learn that what are the method to calculate 250 and why we have to opt in the first tax return. Okay, then we are continuing with the same. Now we earlier seen the immovable property. Now under that we have the intangible asset. Now we are two of three. In previously one of third we covered under the transitional relief. So the same way qualifying intangible asset owned first tax period. So what we gonna do that election? He's saying the election. Under the first election, another three election. If we make no under first election, of course, these three election will not be appearing. On before first tax period, we will say yes or no. The further implication will be there. So if we are saying yes, so now what is that? Section 4 under accounting adjustment. See, this is the reference where it will be pop up, because at the initial stage you will make yes, but the adjustment coming under accounting section. Transitional adjustment will be add up as earlier we seen. If we say no, no further implication. In case of yes, section 4, transitional box will be adding on. So what is the box? This is the box has the taxable person disposed of. This will not be appearing along with election. This will be appearing under accounting adjustment under section 4. So what is the additional field will be added? This is the additional field, disposed of any qualifying asset. Right? If we say yes, then we have to give the figures. Whatever the figure that asset we sold, maybe 50 million, 20 million, whatever the, but this is the intangible asset. If we take this previous example and we assume that that is intangible, so 250 million will be adjusted. This adjustment reducing your taxable income. This is the income reducer. There is a two kind of reducer at the adjustment. One is the income reducer, taxable income reducer. One is the tax reducer. Tax reducer, the tax liability reducer. Okay. Of course, we will dive and learn this part, but so far we are on the computation of taxable income. So whatever the adjustment we are calculating from past 3 or 4 sessions on the taxable income reducer, taxable income computation. Okay, so now what is the third? Qualifying financial asset or liability. Financial asset or the liability, or maybe, so the word is and or maybe both. We have depends. Okay, the same way. This is the third election under the same election, transitional relief. So maybe some industries they have, some industries they don't have, but mostly the big corporate they have it. So the same thing on prior to the first tax period. If we're saying no, no further implication. If we're saying yes, so further implication will be appearing. Now we the symbol we did not opt no, because in case of no, no further implication. But if we opt for the yes, as we said yes, then the section 4 under accounting adjustment, transitional box below will be open. The same, the adjustment is needed. The adjustment is needed. So same if we say no, okay, then again it will be closed. But if we opt for the, see, in case of no, no further adjustment. But if we saying yes, so this field is appearing. We have to make the same adjustment. Now in the question in the election itself, two term is used. Election itself, two term are using. One is the financial asset, another is the financial liability. If you look here, financial asset and the liability, right? So the text will now in the adjustment he will ask particularly the same one by one. But on other side, important part, throughout the return computation, if is a gain, he will ask separate field. If it is a loss, he will ask the separate. Commonly, we are keeping the one chart of account, but law is looking for the traceability separately for gain and loss. Keep in mind, Might be do manual work or keep the separate chart of account for gain and the loss. Same thing for interest also. Interest income and interest expense we previously learned. If we keep the separate chart of account, it will be good for us. It will reduce our traceability efforts. Okay, because in the financial statement at trial balance standalone, we can see okay how much the gain, how much loss. Otherwise, we have to go in the relevant journal ledger and we have to do the manual calculation. Okay, this is for the asset, and same thing for the financial liability. The same way another question will be appearing. So now we are coming to the same topic we understand in the next level. What is the next level? We are seeing the transitional rules. This is the our topic. Then this transitional rule and coming under unrealized under the election. Under election, we set the realization basis or unrealization basis. So now here we are saying unrealization basis, which ministerial decision 120 is dealing with this. 120 is dealing with this. And what is the important start of the first tax period? This is the important we understand. So now here is the again we defined the first of three, second of three, three of three. So what is that? So here the calculation. What is important? Of course, we have to learn the calculation. How we gonna do the excluded gain calculation? The word excluded gain, keep in mind what we are looking for, because if you skip from your mind excluded gain not subject to tax. Excluded, what is the excluded? Not subject to tax. If the figure, so which means if figure is high, excluded AD, exclude. If figure is high is good for us, or figure low is good for us? Is good for us from the business owner perspective. But if the figure is low, excluded gain is low, is good for tax authority. Why? They will come higher tax. Okay. Decrease the lower is good for the tax authority, higher for. But this why I'm highlighting, because here they mention higher of, but the higher of opposite, not the gain, about the cost. Okay, so this is why I'm highlighting, I'm trying to emphasize on that. If we know what we are looking for, then it will be easy to understand. It will be easy to understand. So let's start with our first one of third, the immovable property. Immovable property. The immovable property, what we are looking for? Gain. Gain on which we will not pay tax. Why we are not saying the loss? Because as a prerequisite, we discuss it should be expected to sold on the profit or the gain. Then this all calculation will be relevant. Okay, so now there is a two method under the transitional immovable property. There is a two method. One is this, one is this. Method 2, and this is the first method. Right? The same, we have the two under the immovable property. So let's see the method first. Method to calculate transitional rate at the start of first tax. Right? So now let's see that under direct method. Method 1. What we gonna do that? Calculate excluded gain. Sales, market value. Sales at deemed value. Deemed is we didn't actually sold. We are saying at market this value will be there at the start of first tax period. This is same we discussed. Okay. So now minus, this is the important part. We have less higher of original cost versus net book value. This is the important concept we have to learn, original cost. Let's say in 2020, original cost asset is buy at the 500 million. And 2023 December, the net book value is 350. Why? Because minus depreciation. So cost minus depreciation. So this is net book value. So now they're saying the market value, the deemed value. Let's say we took the valuation from the one of the certified valuation company approved by RERA. The property value, it can be property, it can be plant, it can be anything. Okay, so that in the first starting in this session we discussed. I'm just taking the property. Why? Because it, easily understand. The plant is one of the technical area. Of course, we have to do the same way, but the property valuation, if we took the property, if let's say this is the uh, warehouse, as earlier we discussed, the labor accommodation. So they have this property. So if this property, the valuation as of now, net book value is a 350, and they took the valuation, it's come the 650 million because the market prices are changing. So at this moment, based on